You've probably seen a chart like this before, right? To most people, it just looks like total chaos. A bunch of secret codes written in a language of spikes and dips and colors. But here's the thing. It's not random at all. It's actually a story. And over the next few minutes, we're going to learn how to read it and hopefully turn all of this confusion into some real clarity.
So what are we even looking at here? This is a real-time chart for crude oil futures. And yeah, I get it. At first glance, it is just a flurry of activity. You've got price bars jumping all over the place, these spikes down here, this whole other panel of lines at the bottom. It feels completely random. It's honestly a little intimidating.
But what if it isn't just random noise? What if what you're seeing is actually a super detailed story? A minute-by-minute account of this huge global battle between buyers and sellers? Because, the goal here isn't to predict the future with some crystal ball. It's really just to understand what's happening right now, to read the story as it's unfolding in front of us.
All right, so how do we even start reading this thing? Well, our first tool is something called a Japanese candlestick. The best way to think about them is like they're snapshots of the market's body language. Each one tells us so much more than just where the price went. It tells us kind of how it felt on its way there.
So what is a candlestick exactly? Well, essentially, each one of these little bars represents a slice of time. That could be just 1 minute, it could be an hour, or even a whole day. And in that one little shape, it packs in 4 super important pieces of info: where the price opened, where it closed, the absolute highest point it reached, and the lowest point it touched.
And the color? That tells you who won the battle during that time period. It's pretty straightforward. If the candle's green, it means the price finished higher than it started. The buyers were in control, they were pushing the price up. We call that bullish. But if it's red, well, the price finished lower. The sellers were in charge, pushing it down. We call that bearish. See? Simple, right?
Okay, let's go back to our chart and see this in action. Take a look at this long, solid green candle right here. Now the length of that body, that's the key. It tells you this wasn't just some small victory for the buyers. No way. This was a decisive one. It shows they stepped in with some serious force and conviction, just driving that price way up during that time.
Okay, so we know the candles show us the little battles over price. But what about the force behind those moves? The momentum. For that, we're going to need a different tool. Let's look down at that separate panel on the bottom of the chart. Think of this as our momentum meter. It's called the MACD indicator. Now, the full name sounds super complicated: moving average convergence divergence. But trust me, the concept is way simpler. The MACD basically just tracks market momentum. It does that by comparing a fast-moving price average to a slower one. The best way to think about it is that it's just trying to answer one simple question: is the trend we're in right now speeding up, or is it starting to run out of steam?
So the most important part is just knowing how to read it. And really, you've only got 2 main lines to watch. You've got the blue line, which is the faster one. It reacts more quickly to what the price is doing. Then you've got the orange line, which is slower. Now the magic moment, the key signal we're looking for, is when those 2 lines cross. That crossover can be a really great early warning that the market's momentum is about to change. So if we hop back to our main chart, you can see the MACD has its own little space right there at the bottom. And everything that's happening down there with those blue and orange lines, it's directly reflecting what the candlesticks are doing up top. They're basically 2 different windows looking in on the very same story. Okay, and this is where things get really powerful. See, using candlesticks by themselves is helpful, and using the MACD on its own is also helpful. But using them together? Wow! That's how you get a much, much clearer, higher resolution picture of what the market is actually trying to tell you.
It's like what Aristotle said. The whole is greater than the sum of its parts. When our different tools start telling us the exact same story at the exact same time, that's when we really need to pay attention. There's actually a term for this that traders use. They call it confluence.
Let's find a perfect example of this. Look closely at the MACD down at the bottom. See the spot right here. You can see the fast blue line crosses above the slower orange line. That crossover, that's our signal. That's the MACD basically screaming at us that momentum is shifting to the upside. The bulls might be waking up.
Okay, now, trace a line with your eyes straight up from that MACD crossover to the price chart right above it. What do you see happening at the exact same moment in time? We're not seeing little, weak, hesitant candles, are we? Nope. We're seeing strong, confident green candles start to pop up. The price action is perfectly confirming the signal we just got from our momentum indicator. And what was the result of that? A nice, sustained upward move in price. The story just lined up perfectly. The MACD told us momentum was shifting, and then the candlesticks came in and confirmed that, yep, buyers were taking control. When both of your tools are in agreement like that, it's a much, much stronger hint about where the market might be trying to go.
So really, that's the core idea right there. You're just looking for agreement. You're using one tool to confirm what the other one is saying. When the story you're reading from the price candles and the story from the momentum indicator line up, look, it doesn't guarantee a specific result, but it for sure builds a much stronger case and helps you spot these higher probability patterns.
So there you have it. We've gone from what looked like a completely chaotic screen of lines and colors to something that's, well, a readable story. So let's just do a quick recap of the main ideas that helped us get from all that chaos to this newfound clarity.
Okay, so let's hit the key principles one more time. First, just remember that every single chart is telling a story about a big fight between buyers and sellers. The candlesticks, they're your play-by-play, showing you the outcome of those battles in real time. Then you have indicators like the MACD. Think of that as the expert commentary, measuring the momentum behind all the action. When you combine these tools, you can spot those stronger, higher probability patterns. But, and this is seriously the most important part, this is always about analyzing probabilities. It is never, ever a guarantee of the future.
So what do you think? Now that you've seen how these tools can work together to tell a pretty clear story, do you think reading a market is a pure science, all about rules and indicators? Or is there maybe more of an art to it, about interpreting all the little nuances of that story as it unfolds? Definitely something to think about.